Welcome to this special edition of our podcast, Trade Finance Terms Explained, recorded live at the ITFA Educational Seminar at A&O Shearman in London in July. We brought together some of the industry's leading minds from the ITFA board and beyond to break down the key concepts of trade finance in plain English. Whether you're new to the field or looking to refresh your knowledge, this short-form explainer series covers the fundamentals from basic instruments to regulation, ESG and risk mitigation. Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury and cash management.
We bring you expert insights and the latest trends shaping global finance. Let's dive in. Before we get into the mechanics, let's start with the big picture. What exactly is trade finance and why does it matter to the global economy? Here's Sean Edwards.
Morning, afternoon, evening, everybody. My name is Sean Edwards. I'm chairman of ITFA, International Trade and Forfeiting Association. Great pleasure to be speaking to you. So I've been asked the question, what is trade finance? And that's that's not a yes or a no type of answer. There's a lot of moving parts to trade finance. I think the first thing is that trade finance is really what oils trade, obviously. Trade is super important. And, we've seen the effects that the recent tariffs and other tensions have had on the global trading system and how important that's been. And there's a good reason why this is always in the headlines. It's important to everybody. It's the way that the world lifts itself out of poverty. It's the way the world improves, not always in an optimal way. But without trade, which has been around, of course, for millennia, we don't advance as a planet. So trade finance, as I say, oils those wheels. It's become increasingly complex. And the reason for that is it's not just about providing money. It's not just about giving loans to people. And the reason that's important is that banks need to, especially banks, and it is mainly banks that finance trade finance directly or indirectly, they need to provide funds based on their cost of capital. That has become more difficult. So trade is a good business. It's a very low risk business, but it's a business that's been sort of hammered a little bit by capital regulations. Firstly, there's a lot of data available in trade. So it also gets hammered on the compliance regulations, the sanctions side of things. So it's become an increasingly complex business. It's become harder to do something which to many of us seems sort of very straightforward. And that means that we need to have a lot more people participating in the whole system. Of course, we have people structuring deals like lawyers and various risk advisors, but increasingly some of that risk has to be laid off to non-banks. So the insurance industry, especially the CPRI, the political risk and non-payment industry is increasingly becoming involved in trade finance. And that allows banks to lend in a way that makes sense to them and also actually increases the amount that they can lend. So trade finance at its heart, it looks at documents, it looks at instruments such as bills of exchange, bills of lading and so on. It takes the data from those and it secures itself more or less successfully against those goods. And that's why there are a lot of lawyers involved in structuring trade finance. So as an association, and what we're doing here today, as I'm being recorded, is to educate people on trade finance. And it's a very intense one-day course we do. And I think that reflects, as I say, the number of participants and the complexity of world trade. So that's it, not in a nutshell, but in a sort of slightly elongated nutshell.
That was Sean Edwards. So now we know why it matters, but how does it actually work in practice? From contracts to credit, Duarte Pedreira walks us through a typical trade finance transaction and how it works.
Hello, I'm Duarte Pedreira. I am the Global Head of Trade and Working Capital Finance for Crown Agents Bank, board member for the ITFA, and also the chair of the newly created TFCOP task force. One of the things that most people ask me is, okay, so what is the genesis of trade finance? What is the raison d'etre, the purpose of trade finance? Why does it exist? And it's interesting because as practitioners, we tend not to think about it. But in a nutshell, in between importers and exporters, there are a number of risks that separate them. Normally, as I say, an importer will want to pay as late as possible. An exporter will want to get paid as early as possible. So, of course, these two streams sit on opposite ends of the scale. And the reason for an exporter to want to be paid early and for an importer to want to pay as late as possible is that there are a whole host of risks sitting between them. For one, country risks, where a country may run out of hard currency and hence an importer may lose its ability to pay an exporter. Or the flip side of that, a country might go into trouble with the world authorities, as it were, and lose its ability to export whatever is trying to export. Then, of course, commercial risks, which boil down to the individual entities' abilities to fulfill their obligations on the contracts. For the importer, the obligation to pay, and for the exporter, the obligation to deliver. And you can add so many more. You can add currency risks, obviously. If the importer's local currency depreciates a lot and the importer is given a long repayment deadline, then of course it runs the risk that its receivables in local currency won't be able to generate enough hard currency to repay the exporter. So what does trade finance do? Trade finance is where the financial sector comes in, knight in shining armor, to save the day and bridge all of these risks. The financial sector takes the risks from importers and exporters, and of course, in return, asks for due compensation. But it's not just that. The financial sector also offers, aside from credit support and risk support, also offers much needed funding to bridge cash flow gaps that may exist for both importers and exporters. So in conclusion, trade finance is absolutely critical to keep the world developing, growing, and of course, different nations trading with one another, which is, regardless of current political circumstances and theoretical views, still, in my opinion, a must-have in the current world where we live in.
Thank you, Duarte. Of course, not all deals are the same. When it comes to commodities and more complex arrangements, how are these transactions structured and secured? Daniela Bardier explains.
Hi, Daniela Bardier, and I'm a partner at Sullivan & Worcester. And I've been asked to speak on structured trade finance deals and security that you will often see with these transactions. Really, in structured trade finance, we are looking at taking security over three particular areas: over the goods that are being financed, the receivables, so the right to receive a payment from the end buyer, and also the money that is in the collection account. You have to take a look at whether or not the security is able to be taken over those assets in your relevant jurisdiction, what control you are going to have over the account into which the buyer is going to deposit the funds, and also whether or not you can assign the rights to the receivable. There are a variety of ways to structured financing, depending on the assets, on the jurisdiction in place, the level of control that you want to have over the goods.
Thank you, Daniela. Let's shift focus to one of the lesser known but powerful tools in the trade finance toolbox, forfeiting. Lorna Pillow introduces the basics and its role in liquidity and emerging markets.
Morning, Lorna Pillow. I'm Deputy Chair of ITFA, Deputy CEO and COO at LFC. So what is forfeiting? Forfeiting is the without recourse financing, discounting of traditional instruments, mainly promissory notes and bills of exchange. The reason when we started the educational seminar of introducing modern forfeiting is that we realized that although forfeiting existed for a very long time, it was no longer used as a terminology or a brand, if you like, by the other institutions, whether the banks or the non-financial institutions. We therefore felt that given the importance of negotiable instruments such as promissory notes, bills of exchange, the robust legal and operational framework which they work, we needed to do something more as an industry so that people are more aware of how they protect us, in the sense that they're abstract from the underlying transactions. And personally, from a day-to-day job, I've also tested the rules, the URF 800 rules, which we set up a few years back, to also have some standardization, so that obviously when counterparties deal with each other, they know what to expect, both in the primary and the secondary market. At the time, the most important article was Article 13, which basically leaves fraud with the supplier, because obviously the party who is closest to the transaction is the one who can do the most due diligence.
Lorna stays with us to explore something a bit more cutting edge, digital trade instruments and the URTEPO rules that support them. We'll let Lorna explain.
What is URTEPO? In a previous session, I had discussed URF 800, which was the standardized rules that ITFA had put in place so that obviously counterparties know what to expect when dealing with each other, both on the primary and the secondary market. As things change and the digital instruments came to place, especially with the enactment of the Electronic Trade Documents Bill, the Market Practice Committee at ITFA decided that it was the right time that we would also introduce URTEPO, which are the Uniform Rules for Transferable Electronic Payment Obligations. The objective of the rules was the way these digital instruments are transferred, rather than getting into the technological terminology. And in fact, the rules are neutral in terms of technology. We assume that there is a reliable system, and we also assume a world as set today where digital and paper both coexist into the transactions. URTEPO coexists with other rules, such as URF 800. And from a personal perspective, I can say that we have tried also to implement systems at London Forfeiting so that we can offer digital solutions to our clients, where obviously there's less manual work, there is less risk of fraud, it's much more efficient because institutions in different jurisdictions can close a trade transactions in a couple of minutes. So we're all very excited to see this development in trade.
From digital rules to working capital solutions, supply chain finance is reshaping how corporates manage liquidity. Celia Kalak breaks down how it works and how it's different from traditional trade finance.
I'm Celia Kalak. I'm a board member of ITFA in charge of regulatory advocacy, and I'm also the treasurer. And then I'm working for Banco Santander, where I'm in charge of private debt mobilization for supply chain finance and documentary trade finance. Now, you have asked me, what is supply chain finance? Supply chain finance is used in many different ways. Sometimes when we use the term, we talk about a specific trade finance technique, and sometimes we are referring to a large concept. In order to avoid confusion, I would like to refer today to the definition which the Global Supply Chain Finance Forum set up in 2016 and which is very clear and comprehensive. It goes as follows. Supply chain finance is the use of financing and risk mitigation practices and techniques to optimize the management of working capital and liquidity invested in the supply chain finance processes and transactions. Supply chain finance is typically applied to open account trade and is triggered by supply chain finance events. Now, what does that mean? What can we learn from that? First of all, it is a portfolio of techniques. It's not just one technique. There are very different possibilities to finance supply chain, starting from a simple forfeiting of a draft up to the very complex asset-based securitization of a receivables program. Then, the definition says that it is mostly referring to open account, so simple invoices. But not only. I have, for instance, a supply chain finance client who finances its supply chain with bills of exchange. Who are the parties in the supply chain finance transaction? There is the seller, the buyer, and the finance partner or the security partner. What do they want to obtain with the supply chain finance? First of all, the buyer wants to have a stability so that it can make sure that its suppliers will provide the same quality for a long period, that they can plan with the goods they receive. At the same time, the partners want to have liquidity in the process, because from the moment when you buy the raw material until the moment you can sell the final product, you have a gap, and this gap must be financed. Then you want risk management. The supplier wants to be sure that the buyer will pay at maturity for the goods he has delivered. And last but not least, we all want to achieve balance sheet efficiency, which leads then to better ratings. The next point, which the definition says, it's event-driven. Throughout the whole supply chain, you have different events, starting from the planning of the procurement to payment orders, putting products in warehouses, supplying, delivering products, issuing invoices, accepting invoices, and so on. At each of these events in the supply chain, different supply chain finance techniques can be applied and they can be combined. Last but not least, supply chain finance is evolving. It started from the simple forfeiting of a bill of exchange, and now we have a complex, deep-tier supply chain finance projects on which ITFA has a specific work stream at the moment. So it is a very interesting field to discover, and it is super useful for all of us.
Now let's go back to the basics with a quick overview of the main trade finance instruments: letters of credit, guarantees, bills of exchange, and more. Here's Simon Cook.
Hello, my name is Simon Cook. I'm a partner at Sullivan & Worcester UK LLP and also a member of the executive board of the International Trade and Forfeiting Association, ITFA. And I'm here just to briefly talk to you about trade finance instruments and run through an overview of what they are. The main instruments that we come across in trade finance are letters of credit, both documentary and standby, demand guarantees, promissory notes, bills of exchange, and they vary in some ways, but they all have the same job to do when it comes to financing trade. They act as a go-between between various parties to allow transactions to happen. They are really the glue that holds the trade finance market together. So if I start off with letters of credit, you have documentary letters of credit, which are instruments put in place to allow buyers and sellers to achieve the objective on cross-border transactions of being able to protect themselves. For example, buyers do not want to make payment until they receive goods. Sellers don't want to allow goods to be received by buyers until they've been paid. So these instruments allow an intermediary in the financial sector to act as go-between. Effectively, the buyer asks the intermediary to issue a documentary letter of credit. They issue that in favor of the seller. The seller has to provide certain documentation under the terms of the letter of credit, and provided that it does so in compliance with the letter of credit, the bank that issued it will make payment and will pass the documents on to the buyer, which allows the buyer to then collect the goods. Both parties are therefore protected. A standby letter of credit works in a very similar way, except it's not the intended method of payment. It's a fallback in the event that a buyer does not pay. So again, an issuing bank would issue a standby letter of credit in favor of a seller. And if the buyer fails to pay on the due date under the contract, the seller will make a claim under the standby letter of credit and will receive payment from the bank, who will then claim reimbursement from its customer, the buyer. So they work in very similar ways. A demand guarantee is very similar to a standby letter of credit. The reasons why both exist are historic, because US banks were unable to issue guarantees back in the day. And so they have developed separately over time, but economically and commercially, they achieve very much the same objective. And that is the issuance of a document which allows the seller to receive payment when there is a default by the buyer in doing so. Promissory notes and bills of exchange are slightly different animals. They are issued between commercial parties, buyers and sellers. In the case of the bill of exchange, occasionally with the involvement of the buyer's bank. They are essentially promises or orders to pay some certain on demand or at a future determinable date, and they're given in writing and signed by the person giving the obligation. They achieve certainty because as soon as the seller makes a demand under the bill of exchange or the promissory note, the issuer, or in the case of a bill, the drawer of the bill, the buyer, has to make payment. Commonly, this is done at the buyer's bank. If the buyer's bank has accepted the bill at the outset, then they will also be liable under it. But if not, in any event, claim would normally be made at their counters and they would pay out provided they'd received funds from the buyer to do so. They are the main instruments that we come across in a trade finance context and are intended, all of them, to be separate to the underlying commercial transaction and irrevocable and unconditional once issued. And that's the benefit that the seller gets out of the instrument, and therefore indirectly the buyer gets, because it can receive its goods without having to make payment to the seller and potentially not receive it back if there's a non-delivery of goods.
Simon also sheds light on how these instruments are governed. From UCP 600 to URDG, these global rules underpin trust and consistency across jurisdictions.
I'm here to talk to you a little bit about the industry rules that apply to certain types of trade finance instruments, such as demand guarantees, letters of credit, standby letters of credit, and prom notes, bills of exchange. I think the ICC rules that we have cover three of those documents. The UCP 600, as it's known colloquially, covers documentary letters of credit and is very much designed with them in mind. You do sometimes see those rules applied to standby letters of credit, even though they weren't designed for that purpose, but there is enough of an overlap that those rules still make sense when applied to standby letters of credit. But standbys do also have their own set of ICC rules, which are particularly designed to apply to those types of instruments, which is colloquially the ISP 98 rules. Because documentary letters of credit are the intended means of payment and standby letters of credit are only a fallback if there's a non-payment, there are certain rules in ISP 98 which would not make sense in the context of documentary letters of credit, which is why those rules only apply in reality to SBLCs. The third set of rules are the URDG 758 rules, which apply to demand guarantees. Now, all three sets of rules that I've been talking about cover very similar sorts of issues and have similar principles. So they have that principle of irrevocability, unconditionality. They deal with things like how and when documents have to be examined, what sort of timeframes you have for payments, what rejection rights an issuing bank or a confirming bank may have. They also look at how you might deal with amendments and also assignment and transferability. Now, they don't all deal with these topics in the same way. You certainly can't have a one-size-fits-all, for example. One relatively recent difference is the way that they each dealt with the pandemic and what would happen when you aren't able to present documentation because of the restrictions. They all dealt with it in a slightly different way. And the best way to understand them is really to read them. It's not possible to do a complete comparison for the purposes of this discussion. The industry rules are not the only thing that apply. There's also the applicable law. Query whether you have an express governing law for letters of credit, standby letters of credit, demand guarantees. You certainly can and frequently do, although equally it's common not to have one because the parties don't wish to have the argument over what governing law to choose at the outset and prefer to rely on the fact that actually everything will run smoothly and they'll never have to have that discussion. But if they do ever have to have the discussion because something goes wrong, that can be a painfully long and costly process and with an element of uncertainty as to what the ultimate answer will be. If you don't have a governing law, URDG 758 in the context of demand guarantees does actually set out certain principles for how you ought to determine the governing law if you do need to apply it, but UCP 600 and ISP 98 don't have that type of provision. In terms of assignability and transferability, all three sets of rules deal with this with some overlap. There is a blanket ban on transfers unless the instrument itself expressly says that it's permissible, but the rules take different approaches as to what additional requirements there may be to achieve the relevant transfer. All three allow, in any event, assignment of proceeds, if not necessarily a transfer of all of the other rights under the instrument itself. But even on that, they differ amongst themselves And it is very important to familiarize yourselves with each of the sets of rules on these points, as they, whilst overlapping in some respects, are in fact different in other respects. The instruments that I've not talked about are bills of exchange and prom notes. There aren't any ICC rules that apply to those, but there is a discussion ongoing at the moment around governing law and whether or not you can have an express governing law, or whether the Bills of Exchange Act of 1882 precludes that. There are two schools of thought, but in any event, there is a current consultation process ongoing to clarify the position so that it becomes clear that an express governing law will be possible in certain circumstances. And the consultation is really around the scope of the individual contracts that make up the overall Bill of Exchange layer of contracts can apply. It may only apply to the original parties and the current holder. It may apply more widely depending on where the consultation process comes out.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. Now we zoom out slightly because trade doesn't happen in a vacuum. Zulema Townsend explores some of the key regulatory frameworks shaping supply chains today.
Hi, my name is Zulema Townsend. I'm an associate in the Environment and Climate Law Group here at A&O Shearman, and I'm about to talk about some of the key kind of supply chain regulations that companies should be aware of at the moment. So in recent years, we've seen a steady increase in regulatory developments aimed at enhancing corporate transparency and accountability, particularly as regards sustainability. We've seen supply chain impacts continue to be a key focus in a number of these regulations, particularly in the corporate reporting space, supply chain due diligence, and in the product stewardship space. So in the corporate reporting space, what we've really seen is a shift from a voluntary reporting framework to more mandatory reporting frameworks, whereby companies in scope of these regulations are actually expected to report quite extensively on granular information as regards sustainability, risks and opportunities facing the business, including impacts on the supply chain. A couple of examples here are the Corporate Sustainability Reporting Directive, which is a regulation and directive at the EU, and the introduction of the International Sustainability Standards Board standards, which really created a global baseline of sustainability disclosures and are being transposed into domestic law in a number of jurisdictions around the world. We've also started to see a direction of travel, particularly in the EU, of the introduction of mandatory supply chain due diligence obligations for companies, with a particular focus on human rights and environmental impacts. Most notably is the Corporate Sustainability Due Diligence Directive in the EU, which introduces mandatory human rights and environmental due diligence obligations on companies, and also expects companies to actually act and take action with respect to identified adverse impacts, addressing and mitigating those impacts even within their supply chains. So lastly, we've seen a broad EU agenda tackling global supply chains in the product stewardship space. Some of these regulations include the forced labor regulation, the conflict minerals regulation, and the deforestation regulation. And at a very high level, these regulations may expose various actors within the supply chain to potential liability under the regulations for products that they placed on the EU market where those products and their component parts haven't been sustainably sourced.
Thanks, Zulema. And building on that, Isabella Lewis explained why these regulations matter and how they influence everything from compliance to competitiveness.
Hi, I'm Isabella Lewis. I'm a Senior Associate at A&O Shearman in our Trade and Commodity Finance Group. So why are the regulations Zulema has mentioned important? Well, aside from their intrinsic value, let us think a little bit about why they're commercially important. And there are 4 key factors to consider here. Firstly, financial penalties on enforcement. Some of these regulations can have heavy financial penalties if levied in full, and that is something that businesses will be conscious of. Secondly, business interruption. Other penalties can involve removal of products from the market and, of course, the attendant financial consequences of that as well. Thirdly, consumer views and the potential for litigation or indeed activism affecting the business. And fourthly, contractual elements. It may be that the business has contractual commitments to comply with laws, for example, in an LMA-style loan, although these are seen in other products as well. And in that case, there may be penalties under those documents. And then for a finance provider, why is this important? Well, of course, the supply chain and supply chain finance are inextricably interwoven. And so it will be very important, as always, for finance providers to remain close to their clients. And for both sides, this must be remembered that this affects multiple products and multiple sectors. So it's certainly not a narrow issue.
Day 2, and let's turn back to a timely topic, sustainability. ESG is increasingly part of the conversation in trade finance, but what does that actually mean in practice given everything that's going on in the world today? Sean Edwards, back over to you.
Good morning, afternoon, evening, everybody. I'm Sean Edwards, Chairman of ITFA. Pleased to be here with you again on TTP. So today I'm going to talk about ESG. What does it mean for trade finance today? What is ITFA doing about it, and how is the market coping with it? So I guess a couple of things. We've heard a lot about ESG being under pressure, being scaled back, being maybe cancelled. A lot of that, of course, because of the pressure from the United States. And people are confused at the moment. I mean, if you look at the EU, they have re-examined. The EU probably is the leading legislator for ESG rules. They have begun to re-examine those rules or defer them or water them down in some way. But I think the bottom line is ESG is here to stay. The level at which you'll have to do it and the way in which you'll have to do it, though, is changing. There's a lot of standards around, alphabet soup and a sort of jungle of different people providing either the law or providing guidance as to how to meet your responsibilities. With what's happened in the US, there's obviously a lot of confusion. So what are we in it for trying to do about this? We will be launching at our conference in Singapore in September. We'll be launching what we call the SROI model. So the SROI means social return on investment. It's a model that we've created with Dr. Rebecca Harding. The idea is to try and create and provide to our members a relatively simple, straightforward and sort of cost-effective way of calculating essentially what your ESG imprint is. It's going to be transaction specific, so it'll be up to each user to input the information, but it's relatively simple. The other thing I think it's really worth pointing out with ESG is there's always a lot of emphasis on the E. What we've found, being the sort of very broad association that we are, what we found is that there needs to be a lot more emphasis on the S, the social side. And that can be difficult in certain transactions. So a transaction or a deal or a project or a trading flow that brings a lot of benefits in terms of jobs, for example, can be in the short term polluting. So we have to balance all of that. Now, what our emerging market members, especially in Africa, have told us is that that S part of the equation is undervalued and ignored. And it's much harder to evaluate that. There's a lot of science around the E, right? A lot of climate science. You don't have that so much in the S. It's a bit more subjective, but we think it's really important to emphasize that it does exist and that it needs to be measured and that it's a worthy part of that overall calculation. So that's what we'll be doing. So I guess bottom line message is it's confusing at the moment, as are a lot of things in the world, but it's here to stay. You can't just say this was a trend, this was something that was happening last year, I can ignore it, like last year's fashions goes to the back of the cupboard. Not at all. You're going to have to continue dealing with it, and we're here to help.
Of course, no discussion of trade is complete without risk. Paul Coles outlines how trade finance professionals manage country, credit and payment risk in a volatile world.
I'm Paul Coles. I'm a board member at ITFA and chair of the Market Practice Committee, and just going to talk a little bit about credit risk mitigation and why institutions originating risk will typically look at these different risks, which ones they are, and find ways to mitigate or reduce them. So the typical ones are credit risk. That's the biggest one. That's the risk of the obligor not paying back, their ability to honour their obligations. And other risks can include KYC and compliance risks and operational risk. So some of these are easier to mitigate than others. Things like compliance and operational risk is very process driven. You just need robust techniques to be able to be on top of them and identify any issues before they become a real issue. But then credit risk is the more obvious one, and there's a very established secondary market for trade finance risk. Typically, that can be through channels of bank-to-bank participations. It can also be the use of insurance. So there's a very well-established insurance market for trade finance. There are other channels that are growing nowadays. We have more institutional investors who want to invest in trade finance assets. So developing the right techniques that can make that easy is quite important. And generally speaking, the last big one is obviously the more syndicated loan approach, and also securitizations are useful for bigger transactions, but they also have their advantages and disadvantages. So the key is having a toolbox available to any originator of risk so that they can then use the most appropriate in any given situation.
And Paul, we're staying with you. What's an MRPA? And why do banks use it to distribute risk? Let's hear Paul's take.
Just want to talk a little bit about master participation agreements. Basically, they are there to enable the distribution of trade finance between an originator and a participant. The originator has brought the transaction onto their balance sheets and has assumed the credit risk on the obligor, whereas the participant is happy to take some of that credit risk and share in that transaction. But they're not a party to the transaction. They're one step removed. And the participation agreement allows that effective transfer of risk from the originator and the fronting institution to the risk participant. There are two key documents nowadays: the BAF Master Participation Agreement that was published in 2018 under English law, and the 2019 New York law version. Again, preferences as to which one is best or most applicable tends to be driven by the geographies of the respective institutions. But then more recently, there's also been the addition of the ITFA MARA, the Master Accounts Receivable Assignment Agreement, which is very much aligned to the BAFT documentation, but more bespoke to open account transactions such as supply chain finance and receivables finance. Whereas the BAFT Master Participation Agreements more suited to traditional trade transactions such as letters of credit, bills of exchange, and trade loans.
Thanks, Paul. So when things go wrong, insurance steps in, but it's also used to mitigate risk. Chris Hall explains how credit and political risk insurance supports trade and why it's critical for financiers and exporters alike.
I'm Chris Hall, a board member at ITFA, talking about insurance today. So there are two main types of insurance. One is property and casualty, and that is typically what affects us personally: home insurance, car insurance, etc. There's then specialty insurances, which tend to sit outside that. We work within the credit and political risk insurance space, or credit risk insurance, as we're now calling it. And within that space, there are about 70 insurers. They tend to be split into two types. There's the Lloyd's syndicates, who benefit from Lloyd's AA- rating. And there are then company markets who have their own credit ratings. Different buyers of the product require different credit ratings, different insurers, and different reasons for working with them. Beneath that, though, there's the efficiency of the product, and that is how it performs in terms of claims. And the market has some consolidated claims data that over the last 7 or 8 years, there's been 100% claims payout ratio across all of those claims received by those insurers. Even beforehand, back to 2008, the claims payout ratio is at 98%. Shows that the product works. The insurers are very much incentivized to make it work because it validates that the product works. And by extension, it's therefore something that many of the buyers of the product, be that financial institutions, corporates, or others, benefit from.
To round us off, Cruz Gonzalez zooms out to look at the bigger picture, how credit risk insurance helps global trade keep flowing.
Hi, my name is Cruz Gonzalez, and I work at Willis within our Credit Risk Solutions team. I'm also part of the TTP Global Advisory Panel. I am here today to talk about credit risk insurance and the role it plays as an enabler within trade. So credit risk insurance is a key enabler for and within trade finance. It protects lenders and corporates equally against non-payment risk across a range of instruments. It can support them through different asset classes, so receivables finance, payables finance, inventory finance, just loans as well, structured trade loans. This protection not only enhances their confidence in cross-border transactions, but also unlocks additional lending capacity by improving capital treatment. So who buys the insurance? We mentioned them already, but both lenders and corporates alike are using the product. Corporates use it to secure their balance sheet and protects against customer default, while banks and other lenders use this to mitigate and manage their portfolio risk, support regulatory capital relief as well, and expand their lending capabilities to continue to support their clients. So in essence, it is a shared tool that aligns interest of both parties involved and is supporting the growth within the trade ecosystem.
Thanks for listening to Trade Finance Terms Explained in partnership with ITFA. We hope this short series has helped clarify some of the core concepts in trade finance today. For more resources and future explainers, head to the TTP website. Thank you very much. I'm Dipesh Patel, editor at Trade Treasury Payments. Over and out.
And don't forget to follow Trade Treasury Payments on your favorite podcast platform.
Thanks for listening.